Evergrande owes $300 billion and millions of Chinese families may lose everything. You should feel that sentence in your chest because it measures a risk that has been hiding in plain sight for years. You've seen headlines, and yet you probably do not fully grasp how intertwined real estate is with everyday life in China. By one estimate, 70% of Chinese household wealth sits inside property, which means this is not an investor problem, but a societal one. When you walk through modern Chinese cities, you notice space that seems designed for people but is empty, and you wonder who built these structures and why. These ghost cities are not just architectural oddities, they are symptoms of a system built on relentless speculative building and land-driven local government finance. You will soon see how policy incentives, easy credit, and a culture of real estate speculation braided together into a boom that fueled rapid urbanization and breathtaking profit margins. But what happens when the market stops believing in perpetual growth is the central drama of this story. For decades, Chinese growth plugged gaps with concrete and cranes, and you benefited from rising property values whether you realized it or not. Policymakers treated housing as an engine for consumption, financing, and local revenue long before incomes caught up with prices. You should understand that when real estate accounts for 30% of GDP and 70% of household wealth, any wobble in property prices echoes through banks, construction firms, material suppliers, and, most importantly, ordinary homeowners. Evergrande began in 1996 as a regional developer, and you might imagine a small company chasing an urban boom like many others. Instead, Evergrande grew explosively to become China's largest private property developer, and later the most indebted corporate entity on the planet. You will learn how ambition, leverage, and a permissive financial environment allowed Evergrande to outgrow reason and contract obligations at the same time, creating the conditions for a slow-motion implosion that began long before the world took notice. Evergrande's rise was not just about building apartments. It was about inventing a business model that relied on pre-selling homes you had not yet finished. You get the house on paper, the company got the cash up front, and the cycle kept spinning through new projects and new sales. You should see the elegance and the danger in that model because upfront cash made growth look healthier than it really was. And the incentives encouraged speed over sustainability as the company chased market dominance. To feed that growth, Evergrande borrowed in ways that would make conservative bankers uneasy, and you should be uncomfortable about how much leverage they took on. The company expanded into everything from electric cars to theme parks, fueled by short-term borrowing and complex off-balance financing. You will see credit lines, trust products, shadow banking links, and bonds sold offshore that together piled into over $300 billion in liabilities. That staggering figure is both a headline and a symptom of deeper financial creativity gone wrong. If you think of Evergrande as a single company, you miss how it functioned like a financial ecosystem in miniature, blending developer activities with speculative financing. Suppliers, subcontractors, trust product investors, and local governments were all wired into the same machine. You should imagine a long chain where every unpaid bill and missed payment pushes stress further down the line, turning a corporate liquidity squeeze into a social and economic crisis for millions of ordinary people. August of 2021 offers the first clear tremor in this story when Evergrande missed key interest payments and investors finally woke up to a liquidity problem. You felt the headlines then, but the real shock was the speed with which trust began to evaporate across the sector. You should understand that when creditors stop lending and buyers stop believing, assets that once seemed solid can quickly lose perceived value, turning solvency questions into solvency realities almost overnight. September 2021 then became the public inflection point as Evergrande defaulted officially on offshore obligations and credit ratings plunged across the board. You can call it a default, but it was also a signal that the old growth story might be over. You should notice how a single company's inability to service debt sent warning signs through bond markets, property buyers, and local governments, which depended on land sales to fund public services and infrastructure projects. One of the most visceral consequences was the emergence of unfinished apartments that had already been presold to hopeful buyers, and you can imagine the shock of paying for a home that never appears. Estimates later pointed to over 1.6 million unfinished units tied to Evergrande's projects across dozens of cities. You should picture ordinary families, savings invested, mortgages active, and plans stalled, and the human dimension of what might otherwise read as abstract financial statistics. What happened next will shock you because contagion began to spread beyond Evergrande to other major developers and financial counterparts. Companies like Country Garden and several second-tier developers found funding drying up and bond yields spiking to unsustainable levels. You should recognize contagion as a network problem where one failure raises suspicion about counterparties, and in China that meant real estate credit risks started to ripple back into local government finances and broader economic confidence. Suppliers stopped receiving payments, small contractors faced bankruptcy, and banks saw rising non-performing loans. And you have to see how the pain moved through supply chains. Home buyers who had made down payments started organizing and demanding answers as projects stalled indefinitely. You should understand that this is not just a developer problem, but a social contract unraveling, where people who trusted the system now found themselves bargaining for unfinished homes and uncertain refunds. Grassroots movements then began to appear as mortgage boycotts spread across cities where buyers refused to continue payments on unfinished homes. You will feel the irony when homeowners who had been the backbone of the property boom now refuse to finance its completion. You should consider this a turning point, because mortgage boycotts directly pressure banks, developers, and local governments, and they signify a shift from passive victimhood to coordinated civic resistance. Local governments face their own crisis because land sale revenue had been a quiet engine for municipal budgets and infrastructure projects. You can imagine how slower land sales shrink budgets, delay public works, and force difficult fiscal decisions at the local level. You should note that this dependency on land sales created a structural fragility where municipal finance is directly tied to a booming property market that can reverse course quickly and painfully. Banks in China had exposure through loans to developers and through wealth management products that funneled savings into real estate, and you need to grasp how diffuse the risk really was. The shadow banking sector amplified that opacity by moving credit outside traditional banking supervision. You should picture a tangled web where retail investors, trust products, and intercompany lending obscured true liabilities and raised the systemic stakes of any major developer failure. The Chinese Communist Party then faced a delicate dilemma as it weighed allowing market discipline to play out against the risks of social unrest and systemic collapse. You need to understand the regime's incentives because stability is politically paramount and economic pain is constrained by legitimacy concerns. You should see how the CCP opted for a strategy often described as a controlled or managed collapse, balancing selective restructurings, asset transfers, and targeted bailouts without signaling an unconditional rescue of private developers. What looks like indecision is often a calculated approach to avoid moral hazard while protecting social stability, and you should appreciate the political calculus. Authorities moved to prevent contagious runs, deployed state-owned enterprises to take over unfinished projects in some cases, and coordinated local governments to handle urgent housing needs. You should question how effective those interventions can be when liabilities remain enormous, and confidence continues to erode among buyers and investors alike. Evergrande's corporate structure complicated rescue efforts because the company held assets across real estate, finance, and consumer ventures that were entangled with off-balance financing. You have to untangle a complex corporate web to understand why straightforward bailouts were politically and economically unattractive. You should see how messy asset sales, creditor negotiations, and cross-border claims made a clean resolution unlikely, and how that complexity prolonged uncertainty and slowed recovery efforts. International investors felt the tremors too, as offshore bondholders took losses and global markets briefly reevaluated exposure to Chinese property risk. You might have thought this was contained, but global commodity suppliers, multinational contractors, and foreign banks all had stakes that made Evergrande relevant beyond China. You should remember that in an interconnected financial system, a localized slowdown in a major economy can transmit through trade, investment, and sentiment channels to ripple around the world. Analysts compared Evergrande to Lehman Brothers because both failures unmasked fragile finance and triggered wider panic, and you should consider the metaphor useful but limited. Evergrande's collapse was geopolitical, social, and slower, and the Chinese state's capacity to intervene makes the analogy incomplete. You should ask whether a slow-motion, state-managed collapse could produce a Japan-style lost decade, or whether China's different political economy will produce a different outcome altogether. By late 2022 and into the following years, the crisis remained unresolved and recovery was stuttering, and you felt the weight of uncertainty in markets and on city streets. Developers that once seemed invincible struggled to refinance, and new homebuyer sentiment remained fragile, despite policy nudges. You should recognize that the persistence of unfinished projects and mortgage boycotts keeps pressure on both financial stability and social cohesion in multiple cities across China. Policymakers offered support selectively by lowering mortgage rates, easing bank reserves, and encouraging asset management companies to take non-performing loans. And you should note how these are targeted firebreaks rather than blanket rescues. The goal appeared to be restoring confidence without rewarding reckless corporate behavior. You should wonder whether these measures can reignite a private sector-led recovery when the behavioral scars of mortgage boycotts and eroded trust among suppliers and investors remain deep. What happens to Chinese growth matters globally because China remains the world's second largest economy and a source of demand for commodities and manufactured goods. You need to appreciate how a protracted real estate slump could slow Chinese consumption and investment for years. You should consider the potential for weaker global commodity prices. slower trade growth, and a reconfiguration of investment flows as companies and countries reassess exposure to property-dependent growth in China. There is also the human price as millions of workers employed in construction and related sectors face unemployment or reduced wages, and you must weigh how social costs accumulate beyond balance sheets. Local communities built around development projects can suffer long-term decline when projects stop and suppliers fail. You should keep in mind that economic numbers never fully capture the personal stress of individuals who lose jobs, savings, and the promise of a stable home they had paid for in full or in part. Investors and policymakers now face a choice between deeper intervention or a longer period of market-led restructuring, and you should understand how high the stakes really are. A too soft approach risks moral hazard and wasted capital, while a too hard approach risks social unrest and economic shock. You should ask whether China can strike a balance that preserves long-term financial discipline while protecting millions of citizens from the immediate fallout of a broken promise. What will the long-term legacy of the Evergrande crisis be? And you are watching history in slow motion that may define a generation of Chinese economic policy. Some analysts warn of Japan-style stagnation, while others foresee a reset that leads to healthier, if slower, growth. You should consider that the crisis forces China to confront a decades-old growth model reliant on land sales, heavy investment, and property speculation, and that structural reform may be the only remedy for sustainable recovery. In the middle of this uncertainty, you will encounter stories of resilience, innovation, and improvisation as local governments, property managers, and communities seek pragmatic solutions. Some unfinished developments have been taken over and completed by state-owned enterprises, while other projects remain stalled in legal limbo. You should appreciate the messy creativity that emerges when formal markets fail and when ordinary people refuse to accept perpetual uncertainty without action or recourse. International observers will continue debating whether Evergrande was a unique corporate failure or a systemic warning sign for China, and you should realize both views contain truth and risk-selective optimism. The size of liabilities and the social embeddedness of property in China make this more than a single corporate story. You should remember that crises teach lessons about incentives, regulation, and the need for robust safety nets to protect citizens when private finance fails. There are broader geopolitical implications because slower Chinese growth could reshape global supply chains, commodity markets, and investment strategies. And you must watch how other economies adapt. Countries that export raw materials or rely on Chinese demand face practical risks that could alter development plans. You should monitor how multinationals recalibrate and how policymakers in commodity exporting countries respond to a sustained slowdown in Chinese real estate investment. The moral of this story is that massive prosperity built on a narrow foundation can be brittle, and you might ask whether speed and scale should always trump stability and fairness. China's property model delivered growth and urbanization, but left unresolved questions about sustainability, transparency, and social protection. You should reflect on how other economies might avoid similar pitfalls by diversifying wealth, strengthening regulation, and aligning incentives with long-term public welfare. Evergrande's story is still unfolding, and you need to follow it because its outcome will matter for millions and for global markets. This is a crisis not contained to spreadsheets, but one that touches the lived reality of families, workers, and entire regions. You should stay curious because the choices made now will determine whether this becomes a slow decline, a managed transformation, or a longer era of economic stagnation that echoes the worst lessons of history. If you want to understand how a modern economy can build such enormous risks into everyday life, follow the trail from generous lending to speculative buying to complex corporate finance. You will then see that Evergrande was not an isolated accident, but a pressure point where many policy choices met market forces. You should ask whether reforms that reduce reliance on property and strengthen oversight can be politically feasible and economically effective in a society where real estate is deeply personal. The philosophical twist is that enormous systems are built from individual decisions, and you are one small actor inside a larger narrative that includes investors, buyers, managers, and policymakers. What you choose to believe about growth, safety, and success matters because collective choices scale into systemic outcomes. You should remember that crises offer an opportunity to redesign incentives and institutions, and that the path China takes after Evergrande will be a lesson for the world about limits, resilience, and governance. If this gave you a new perspective on how property, politics, and finance can collide, then consider following for more in-depth investigations that connect dots others miss. You will find that economic stories are often human stories, and that clarity comes from patience and careful explanation. You should subscribe to keep tracking Evergrande because the story remains unresolved, and the consequences could echo for years to come. If this gave you a new perspective, hit subscribe.